All right, welcome back everyone to today's Explainer. I am absolutely thrilled you're joining us, even if the markets are giving us every reason to just hide under the covers today. We are doing a full market autopsy of August 6th, 2026. It was a brutal, completely unforgiving trading day. And to really dissect the carnage and figure out the mechanics behind it, we're keeping things strictly black and white today. No colorful fluff, no distractions, just the raw data and the undeniable facts laid bare. We're going to break down exactly what happened, why it matters so much, and crucially, what this sets up for tomorrow. Okay, let's dive right into this structured autopsy. Today's agenda: first, a brutal market reality. 2, AI and software reality check. 3, defense and hardware disasters. 4, the macro vice titans. And finally, number 5, tomorrow's binary jobs report. Starting off with Section 1, a brutal market reality and the broad index sell-off. Man, today was rough. We saw a sharp, painful pullback from record highs across both the S&P 500 and the Nasdaq. And this wasn't just some gentle run-of-the-mill correction. This was a broad slide driven by incredibly heavy losses in specific sectors that are normally high flyers. The sheer weight of disappointing earnings across software, defense, and broader tech names just dragged the entire market down with it. But, in this absolute sea of black and white data, there was one rare standout. ARM Holdings completely bucked the broader tech sell-off. They actually posted a gain of 4.41%. It was practically the lone bright spot in tech today, which really proves that even in a massive sell-off, highly specific fundamental stories can still find buyers. Moving right along to Section 2, AI and software reality check. We really need to look at the absolute carnage here, starting with the Datadog disconnect. Now, this is wild. It's a sheer, brutal contradiction. Datadog actually beat expectations. They reported Q2 revenue of $1.12 billion. That is a 36% jump. And they even raised their full-year guidance. In any normal market environment, that's a recipe for a massive rally, right? But the reality? Datadog suffered a 17 to 19% single-day stock drop. It plummeted toward its largest single-day decline on record, totally blowing past its previous worst drop all the way back in March of 2020. So you're probably asking, why? Well, it all comes down to one singular sentence. Datadog's main AI customer flagged reduced activity for the rest of the year. That right there is the missing link. You see, the market didn't care at all about the strong Q2 revenue because the market is always looking ahead. This single disclosure signaled a potential massive cooling off in enterprise AI spending. Investors have priced these software stocks for absolute perfection, basically assuming limitless AI growth forever. But the moment a major player tops the brakes, the entire growth narrative just fractures. And, the pain in software definitely wasn't isolated. The contagion spread so incredibly fast. AppLovin absolutely sank today, dropping 19.3%. They missed Wall Street's revenue estimates and put out a softer-than-expected outlook for Q3. And then you've got Zillow sliding 12% after a brutal downgrade from Evercore ISI. They literally slashed Zillow's price target in half, from $80 all the way down to $40. And the reason? A structural headwind caused by materially slowing Google-driven traffic. Because when foundational traffic sources dry up, the underlying business model takes a direct hit. The market was taking zero prisoners today when it came to forward-looking weakness. All right, Section 3, defense and hardware disasters. Get ready for the earnings casualties on the physical tech side of the market. So Honeywell Aerospace just put out their very first earnings report as a newly spun-off standalone company. And it perfectly illustrates this sudden collapse in expectations. Their prior guidance for 2026 organic sales growth was a very healthy 7 to 9%. But what they delivered today was a massive downward revision to just 4 to 5%. For a standalone defense and aerospace giant to slash their growth outlook by nearly half on their very first solo outing, that is an absolute disaster. The culprit, according to CEO Jim Courier, was simply supply constraints. But the financial impact of those constraints was just staggering. Because they couldn't get the parts they needed to drive growth, their Q2 EPS missed, coming in at $187 versus the $213 expected. Even worse, GAAP earnings plummeted a massive 71% year over year to just 78 cents per share. The market's reaction was swift and merciless, driving a 21 to 23% crash in Honeywell Aerospace's stock today. Just to put the sheer scale of this hardware and physical manufacturing sell-off into perspective, $130 billion. That is exactly how much of Elon Musk's fortune got wiped out in the month of July alone. Tesla just suffered its worst week since 2022, and the stock is down a staggering 26% in a single month. This is a stunning reversal for a massive hardware stock that was literally sitting at all-time highs earlier this year. It just goes to show you that size and past performance offer absolutely zero protection when sentiment turns violently against hardware makers. Rounding out the micro-level hardware disasters today, we had Western Digital dropping 13% as investors balked at a weak first-quarter revenue forecast. And then there's Peloton tumbling 15%. What's fascinating here is that Peloton actually reported its first-ever full-year net profit. But hey, in this market, you're only as good as your next quarter. Peloton warned that sales are expected to decline in the coming fiscal year as they lap their recent price increases, and that forward-looking weakness completely overshadowed their historic profitability milestone. Next up, Section 4, the macro vice tightens. Let's zoom out to the broader pressures of oil and inflation. So, stepping back for a second, geopolitics are absolutely running the show right now, squeezing the market like a vice. Escalating tensions in Yemen spiked oil prices today well above their baseline. On top of that, there is deep uncertainty growing over the timeline for reopening the Strait of Hormuz. When oil creeps higher, it instantly reignites concerns about energy price-driven inflation, and that is a pattern this market is terrifyingly familiar with. As these tensions rose and traders digested those U.S. hiring slowdowns, safe haven assets caught a massive bid. Gold actually briefly climbed above an incredible $4,200 an ounce. The macro environment is just incredibly fragile right now. Finally, Section 5, tomorrow's binary jobs report. This is the critical catalyst. With all the carnage today, the entire financial world is basically white-knuckling it, waiting for tomorrow morning's highly anticipated data dump. We are talking about the July non-farm payrolls report hitting at 8:30 a.m. Eastern Time. The consensus is hovering around 80,000 jobs added, with unemployment holding steady at 4.2%. But Pantheon Macroeconomics is forecasting an even weaker 75,000 jobs. Now, both of these are slightly up from June's dismal 57,000, but they are still well below what anyone would call a healthy labor market. Plus, average hourly earnings are forecast to rise 0.3% month on month. Here's the thing, you need to understand the completely counterintuitive, purely binary nature of tomorrow's market reaction. Right now, bad news is actually good news for stocks. If we get a weak jobs report, meaning less than 75,000 jobs added, that actually kills the bets on the Federal Reserve hiking interest rates. It removes the pressure to tighten, yields drop, and stocks will very likely rally in relief. But if the economy looks too hot, say a strong jobs number over 150,000, well, that gives the Fed ammunition to hike rates, that pushes bond yields higher, and will almost certainly cause stocks to fall even further. Stock investors actively want a weak labor market right now, just to stop the Fed in its tracks. Because make no mistake, the threat of a hike is very real. The CME FedWatch tool currently prices in a 62% probability of a rate hike at the September FOMC meeting. So the majority of the market still expects tightening. But that 62% probability could rapidly collapse if tomorrow's job numbers miss the mark. That would instantly spark a bond rally and give us some equity relief. Literally everything hinges on tomorrow's print. But wait, it's not just the jobs data we're watching. We are actually looking at a Friday double catalyst. Catalyst 1 is that 8:30 a.m. non-farm payrolls report. Catalyst 2 is a potential formal announcement regarding the Strait of Hormuz Iran-Oman agreement. Donald Trump has indicated a deal could come at any moment. To be totally objective about the market mechanics here, if a formal Hormuz opening announcement, which would crash oil prices, happens to align on the exact same day with a weak jobs report that kills a rate hike, we are looking at a massive dual-engine bullish catalyst for tomorrow's market. And so, as we wrap up this autopsy of a deeply painful August 6th, we're left staring at the stark black and white reality of tomorrow. The table is fully set. The stakes couldn't be clearer. The only thing left to ask is this. Will tomorrow's binary jobs data trigger the relief rally this market desperately needs, or is it going to cement today's brutal sell-off into something much, much darker? Equip yourselves with this data, everyone. Keep your eyes on the facts, and I will see you on the other side of tomorrow's opening bell.